The courage to press on regardless of whether we face calm seas or rough seas, and especially when the market storms howl around us, is the quintessential attribute of the successful investor.
Bogle emphasizes the importance of staying focused on long-term goals and not being swayed by short-term market fluctuations.
Time is your friend. Impulse is your enemy.
Bogle highlights the value of patience and the detrimental effects of impulsive decision-making in personal finance.
Do not let the cacophony of short-term noise drown out the symphony of your long-term goals.
Bogle warns against getting distracted by short-term market fluctuations and losing sight of your long-term financial objectives.
The stock market is filled with individuals who know the price of everything, but the value of nothing.
Bogle cautions against solely focusing on the price of stocks without considering their underlying value and potential for long-term growth.
The miracle of compounding returns is overwhelmed by the tyranny of compounding costs.
Bogle reminds investors to be mindful of fees and expenses, as they can significantly erode investment returns over time.
The stock market is a giant distraction to the business of investing.
Bogle suggests that investors should focus on the fundamentals of investing rather than being consumed by daily market movements.
The idea that a bell rings to signal when investors should get into or out of the stock market is simply not credible. After nearly 50 years in this business, I do not know of anybody who has done it successfully and consistently.
Bogle dismisses the notion of market timing and highlights the difficulty of consistently predicting the best times to buy or sell stocks.
If you have trouble imaging a 20 loss in stock market, you shouldn't be in stocks.
Bogle emphasizes the importance of being prepared for market volatility and understanding the risks associated with investing in stocks.
The most important investment decision you can make is not which investment to buy, but rather how much of your assets should be in stocks versus bonds.
Bogle stresses the significance of asset allocation in determining investment performance and managing risk.
When you make your peace with uncertainty, you find the courage to take risks, but only the right risks.
Bogle encourages investors to embrace uncertainty and take calculated risks based on thorough analysis and a clear understanding of their financial goals.
Investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes.
Bogle simplifies the investment process, highlighting the importance of making sound decisions and avoiding common pitfalls.
The winning formula for success in investing is owning the entire stock market through an index fund and then doing nothing.
Bogle advocates for passive investing through low-cost index funds, emphasizing the benefits of broad market exposure and long-term holding.
In investing, you get what you don't pay for.
Bogle underscores the importance of minimizing investment costs, as high fees can eat into returns and diminish overall performance.
When reward is at its pinnacle, risk is near at hand.
Bogle warns investors about the potential dangers of chasing high returns without considering the corresponding increase in risk.
The greatest enemy of a good plan is the dream of a perfect plan.
Bogle cautions against striving for a perfect investment strategy, as it often leads to inaction and missed opportunities. A solid plan that is executed is better than an ideal plan that remains unrealized.
It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for.
Bogle emphasizes the importance of wealth preservation, efficient use of capital, and leaving a lasting financial legacy.
If you're prepared to invest in a company, then you ought to be able to explain why in simple language that a fifth grader could understand, and quickly enough, so the fifth grader won't get bored.
Bogle emphasizes the importance of understanding the fundamentals of the companies you invest in and being able to explain your investment thesis clearly and concisely.
The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go.
Bogle suggests that true investing success should be measured by the implementation of a well thought out financial plan and the discipline to stick to it rather than trying to outperform the market.
The intelligent investor is a realist who sells to optimists and buys from pessimists.
Bogle suggests that successful investors should have a realistic perspective and be willing to take advantage of market opportunities when others are overly optimistic or pessimistic.
Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas.
Bogle emphasizes the importance of maintaining a long-term perspective and avoiding the temptation to engage in speculative and high-risk investments for the sake of excitement.
In the fund business, you get what you don't pay for.
Bogle emphasizes the value of low-cost index funds as they tend to outperform higher-cost actively managed funds over the long term.
The more you trade, the more you underperform.
Bogle warns against excessive trading, as frequent buying and selling can lead to higher transaction costs and lower overall investment return.
You can't judge a book by its cover, and you can't judge a fund by its name.
Bogle cautions investors against solely relying on a fund's name or marketing materials and encourages thorough research into the fund's underlying investments and strategies.